What's up, team? We about to go over the moving averages. Let's hit it. Moving averages. The definition of a moving average. Moving average is an indicator that is applied to your chart that helps smooth out price by removing the fluctuations surrounding the price movement in question. In other words, the moving average is going to give you the estimate of the closing price for the last however many candlesticks. So if we were using the 50 moving average, it's going to tell us the closing price for the average of the last 50 candlesticks. If you're using the 10 moving average, it's going to be the last 10 candlesticks, so on and so forth. So a few reasons why use a moving average. A moving average can help confirm the market's direction. It can help let you know if it's bullish or bearish. So let's pull one on here. We're going to put our simple moving averages on there. Now this right here is our basic simple moving averages. As you see all these lines because we have our 20, 50, 100, so on and so forth. I don't use that. So we are going to go to the settings and we're going to update the moving averages. For this one, I only use two, the first two. So I'm going to take out the last. The first one is going to be my 50. So that color needs to be green and red. The second moving average is going to be my 200. So I'm going to solid that out to one color. I'm going to change my inputs. And boom. So that's two moving averages, as well as I'm going to add two others, my exponential and my regular moving. Now these I like to set at 10. I like my color for my exponential to be pink and my regular moving average at 10. Oops, this one is going to be blue. So the thing about the exponential moving average versus the regular moving average, the exponential is a little bit more tighter to your candlestick movement. So that's where you're going to get a closer average than you would get a more lax average. So with the moving averages, you can almost have an idea of the market's direction. If it's going to be bullish, bearish, or consolidating. For example, when the 50 moving average is below the market, below the candlesticks, you usually have a bullish market. If the 50 moving average is above, you have a bearish market. Now, when the moving average goes right through the candlesticks, you have a consolidating market. Those are just the simplest rule of thumb you can use when using your moving average. Another way to use your 50 moving average is when it breaks the chart or breaks your candlesticks. So when the 50 breaks through the candlesticks, that's going to be a possible trend change. So you have your moving average right here, broke on your candlesticks, and we had a push up. We have another cross of the moving average on the candlesticks, and we had a light push down, so on and so forth. You can back test that, test it out and try it. It works. It crosses, it usually pushes up, or if the moving average is below, it's pushing up. The moving average is above, it's pushing down. But again, that's with the 50 moving average. Another thing, the third thing, the 50 moving average can also, it can act as a form of support and resistance. So another way, if you aren't too familiar with support and resistance, I like to call it a ceiling. Support, I like to call that a floor. The support, you have multiple bounces off your support here, here, and here. This became support. For it to become resistance, it has to be rejected. It has to be a ceiling to your current candlesticks. That's what resistance is. Now, if you're looking at your 50 moving average, it became resistance here. Boom, 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 resistance. Then it became support on this go downfall. But the support wasn't as close because moving averages, but with the candlesticks, the price action was more on a push up. And it's so many things that you can use to confluence to show that push up is by using your 10 crossing your 50, or your 50 crossing your 200, or your even the cross of your 10s crossing one another. That also shows a direction change. So I like to use the moving averages, these three, the 10, the 50, and the 200. A good rule of thumb, let's show you here. I'm gonna back it up. A good rule of thumb is when you have your moving averages presenting an order, the certain order it needs to be in would be 10, 50, and 200. Anytime your moving averages are in this exact order, you have a push up. Now, when they're in reverse, where it goes 10, 50, 200, down, up, then you have a bearish market. It's the simplest way to use those three moving averages. Now, let's just check this out. You see how this 10 moving average is about to cross this 50? It rejected the 200. Let's go a couple. See that order? We have the 50 here in the middle, the 200 at the bottom, and the 10 on top. That is strong confluence for a push up. I like to use that order and find when I see that order or see the cross of the moving averages, if it's a strong where the 10 is pushing straight up and the 50 is kind of kind of stagnant to where it's going from side to side, like straight across, or it might have a little bullish push to it as well. That works for me. I take that as a nice bullish push. But again, is on top, our 50s in the middle, and our 200s at the bottom. We're in a bullish push. It is not a strong bullish push because of how close our moving averages are. So that just also shows us that the push isn't that strong. But when they have a wide gap and say your 10 would be a little bit higher, for example, so your 10 is like this, and then your 50 is like this. To me, that's a better push. A lot of times you'll find your 10 crossing your 50 just like that. When it crosses like that, man, that's a strong and powerful push. Usually it has a lot of strength behind it. Another way I like to use my moving averages, it shows me the 50 on multiple time frames. Let me show you what I mean. So if I go down to my 15-minute chart, I can tell you exactly where the moving average, the 50 moving average is on my 1 hour. And then on my 1 hour chart, I could tell you exactly where the 50 moving average is on the 4 hour by looking just at my current moving averages here. So let me show you, for example, we are going to do it just like this on a 15-minute chart. As you can see, we have our 50, which is the green and red line, is right here. Our 10s are right here, and our 200s here. So now, again, I'm going to tell you exactly where the 50 moving average is on the 1 hour. So here we are on our 15-minute chart. I'm going to mark this 200 moving average. Boom. Let's mark it right there. And let's go to the 1 hour. Man, if that is not on the money. That, again, this is our 50 moving average on our 1 hour. It has now been marked from our 15-minute chart. Now we're going to mark it for the 4 hour. So this is going to tell us where the 4 hour 50 moving average is. Boom, right there on the 200. Let's go to the 4 hour. Man, it's right there. Very, very close to it. So with that being said, the top-down analysis, people are trying to predict what direction your market is going in. You can't do that. But the best thing you could do, you can get an idea of the zones and the range the market may pull back in. A good rule of thumb is on the 1 hour, that 50 moving average is tested a lot on your 1 hour. The market always comes back to it, breaks it, kisses it, bounces off of it, so on and so forth. So if I am on my 15-minute chart and I see at my 200 moving average that this is my 50 on my 1 hour, I it's pretty obvious that it's more than likely going to come down to this 1 hour 50 on the 1 hour time frame. So if you're on the 1 hour time frame and you're like, okay, I'm waiting, but you're going to wait for it to come to that 50 before you know you have a turnaround. That's usually what happens. And the best way you can check that, test that, is by back testing. Back testing is key. That's the best thing you can do for yourself, is by back testing. So now, So, this is our 50 on our 1 hour, right? So if we're looking at that being our 50 and we're expecting it to come to our 200, we have an idea of how far we can go with our candlesticks. Not only do we have an idea, it kind of helps you range when you may expect a turnaround, when you can expect some rejection, so on and so forth. So it's a good thing to help in confluence to what move you're going to make. This right here, to me, is setting up for a bearish push. Let's check it out. Look like it's going to come on down to this 50. Oh. So as I said, it came. The 10s crossed that 1 hour 50. The 10s were coming down to our 4 hour 50. If we go back to on our 15-minute chart, I saw the same cross, and it just shows the strength of which direction you're going to go in. So my 1 hour is now coming to my 4 hour 50. So it's either going to cross it and strongly cross it, retest it, and pull back. So it's so many ways it could go, but it still prepares you for what may happen. You may be thinking like, oh man, I'm just about to have a nice down push. It's already pushing down, a nice bearish market. That's not necessarily true. You want to watch for the retest and how the candlesticks react to your moving averages. So let's play it out a little bit. Boom. It's kissing it. Oh, it's breaking. The 10s are coming down. Will a 10 cross? Nope. Rejection. Look at that. And it's coming back up to the 50. It's crazy. The moving averages are so powerful. Crossing that 50. Up. Look what we have right here. Let me pause it. We have our 10, our 50, and our 200 order. That order alone usually shows a strong bullish market. Let's watch it a little further. Boom. Wow. So if you were to enter the market when you had your first 10 cross, and let's say you entered it here and you took it up for a bullish push, you could have caught 85 pips just from the fact that the moving averages crossed one another. Just the fact that you had the order of your 10, 50, and 200. Now, the thing is, don't use the moving averages alone. Keep in mind, indicators are something to help us. Indicators don't predict the market. Indicators don't tell us much, but it does help in confluence to what's going on. And all indicators show you what has happened. So a lot of times you may be waiting for this move for it to cross right here. You would have missed some of the action. So if you would have gotten down, let's say a little bit further down before it even had that cross, that's 122 pips. So that's the thing. You missed so many pips because we're waiting for this indicator to give us that confluence. You missed 40 pips. So yet again, use the moving averages, this indicator, use it for confluence, use it to help you and decide where you're going in your market. Now, along with the moving averages, you can use other indicators as well. You should be marking up your chart. You should be marking up resistance and support zones. You should be marking up, taking out the fib and stuff like that. All those things will help you in confluence to your direction. The fib is perfect for you can find pull back and push. Like right here, I pulled the fib out. Here's my golden zone. And as you can see, this is where my pullback came for my next push up. It came back 50%. That's what the 50% pullback is. Any push up, any push down, whatever it may be, you usually get a 50% return. It may take a little time, but let's see. Will it happen? Or will it happen? Boom. So that golden zone was hit. Retest. All right. Are we going to come down to the other one? No, it doesn't look that way. You see how it's riding that 200? That is beautiful. But it came back to test this golden zone. and it's just pushing on up. We got a serious, serious bullish market for GBP JPY right now. It respected my 200, which is also my 4-hour 50 moving average. That's another thing that would have signified to me that, okay, I don't have a bearish pullback just yet. I don't have that 50% in what I thought would have been for this. So that's where you move on. You got to move your analysis and try it again. Okay, so let's move on to a different area. Let's try it here. Boom, boom. We got our 50 right there. We'll take the old one and move it up right there at the golden zone. Came back to it, came back to it. So it happens in some areas and it doesn't happen in all. And the reason why you need to back test, retest, and try out your strategies, because you need to know what works and what doesn't. And when something doesn't work, you need to be able to be proactive in adjusting to the situation. So again, moving averages can be a great of assistance to your trading style, to your trading strategy, to whatever it may be. Keep in mind that 10 above, 50 in the middle, 200 below, you got to push up. Your 200 above, your 50 in the middle, and your 10 below, you got to push down. Cross of your moving averages, you got usually a trend change. You're going to change direction somewhere. It's a good thing to practice and try and see how it works for you, but that's what I recommend doing. I always have moving averages on my charts. I keep them on no matter what, whether or not I'm using them at that moment or not. But it's still something to practice, a good habit to practice. So when I look at the chart, I kind of have a guide of where I'm going. So I go to my top down analysis and I go from there and I break everything down and I keep going down in my hours, because when you do top down analysis on the bigger chart, you have more range, you have a better zone, you have an idea of how far or how low it'll go. So it's a good rule of thumb. A good thing to practice is top down analysis and marking up your charts. It's a good habit to have. Remember, don't trade on indicators alone. Indicators are here to assist you, to give you confluence in the market. Indicators can also mess you up if you are tunnel vision on the indicators. Don't ever trade bias. Don't trade with the indicators alone. I cannot stress that enough. So if anybody has any questions, feel free to comment, message me, or anything, and we will go over it. Other than that, happy trading.